So I hope everyone is seeing us all right. Today is a very exciting session. I'm really looking forward to learn a lot from Sebastian, who has a lot of experience now in investing and overall in financial freedom, actually, because he got retired at 33 years old, I believe. That's right.
Yeah, technically. Yes, technically. We
Yeah.
can go
So
into that, I guess. Yeah, I can give you a bit of a background story around this later.
yeah, we will go into it a little bit later. Ladies, whoever is listening to us, please say hello. Tell us where are you listening from, in what country you are now. I'm streaming from Côte d'Azur today, so in a very good mood, very chilled, but still eager to learn. Yeah, I can see already some of you listening. So do ask questions because we do see your comments. So we will answer your questions and we will answer the questions that you have left previously in the group, in the event. And we also going to have a couple of bonuses for those who are going to stay with us till the end. And before we start, I think we should have like a little disclaimer because the topic is serious. A topic is about finances. So we would like to tell that this session is strictly informative. So if you are going to invest, this is fully your responsibility. So we don't hold any responsibility for that. But yet we are eager to share the best experience about investing and about financial freedom with you. Okay, so we are going to start. Sebastian, feel free to introduce yourself.
Well, first of all, Anna, thank you for the opportunity for having me on your live show. It's an honor, and I'm glad I can speak to a group of women because I think investing is particularly good for women. Just a little anecdote here. There's statistical studies from investing management firms that show that the very best investors are there's three categories of the best investors compared to overall things. Looking at the whole data, the very best investors. It's going to be funny. You're going to find it a bit strange, but the very best ones are first those who are dead or who have forgotten their password to the investing account because they don't trade. They only hold their investment and they have the best returns over the long term. And the second best category are women from that perspective, because women are more humble, they're more careful, they're more thoughtful, and in investing, that is really important. So now when I say there's three categories, and the rest is just all the men who trade and who think they're smarter than everybody else, and then failing basically. No, so that's just for the story. Just why I'm really happy to be here.
That's good that you have mentioned that as well, because I feel a little bit of frustration myself because women don't know much about investments and they don't invest. And of course, they don't then educate their children to invest. While women, they hold such an important position in society in educating their children. And there are a lot of divorces happen as well, and women have this burden of staying with their children and not always having this financial security, let's say, that they can actually have with stock investing. But because we don't know much about it, we don't do it, and we end up where we are, but we could have a better life. We can have a wealthier life, and we can teach our children as well how to invest and being wealthier.
Yeah, for whatever reason, it's a very male-dominated sector, and I think it's wrong because it basically appeals to men because men think they're smarter, but really, as women, you have a lot to contribute, and I think often women will statistically women will be the household chief of finance, right? But that should include investing, and that's not always the case. And if they were in charge of investing, then the household would do better overall on average. So I think it's important, yes, that women take control of their finances, and actually handle even the investing part, which sometimes is left to the guys, which I think is wrong. So on average, and we're talking about averages here, there's probably a ton of different examples where this doesn't fit, but on average, I think this is you are better suited for this investing long-term approach than guys, that's for sure. So yeah, it's weird that I'm the one speaking to you about this, but again, the field is mostly men dominated and we need more women. So the reason I'm really excited to talk about this with you today is because we need you to be the voices, and to take the lead and to show that this can be done and it's easy and you are more successful than men. I think this is really important, and it will be a benefit. It would be good for entire society if we just could invest more wisely. And I think you ladies are better suited for that. Anyway, I keep hammering the same point. But so maybe my introduction quickly. My name is Sébastien. I am from Belgium. I currently live in Belgium, but I was an expat for a long time. I lived for 8 years in the United Arab Emirates in Dubai, and I worked there as a consultant. And like my financial story started because I got to Dubai. I had a very low-paid internship, struggling sort of to make ends meet, and I was broke for a while. I had to fill the gap between my internship and the job that I had just found, and I couldn't make it. I have just so much cash, and that was it. And so I had to borrow money from my brother, and I had to crash at a friend's house, and that was quite a difficult experience for me because, like, I went to Dubai, it's like the country of the riches, and I was supposed to be highly paid and all that, and I was like coming back to my family asking for money and going to my friends and saying, hey, can you take me for a few weeks? I was thinking to a month and a half because I can't pay for my own stuff. And so that was very difficult. Again, that's like the men. Yeah, I don't know. It's just like self-esteem thing, which is not easy to handle when you're a young guy and you're supposed to show off and like build your career and build your life and all of that, and prove to your family and your friends that you know what you're doing. But clearly I didn't. And so that's sort of where it all started. It was a bit of a very humbling experience, but it forced me to take action in terms of controlling my finances. So that's when I started tracking money. And that's the first thing. Like, I just started tracking money, and fast forward 7 years later, I quit my job and I don't need to work for money anymore. So that's sort of the journey. It's a bit of a crazy journey, and I'm happy to go through all this in more details. But basically, what I did is I learned to invest. On the way, I made lots of mistakes. I lost the money, and I invested with financial advisor and all that, all sorts of problems. But in the end, I found a way to do this properly, which is not difficult. It's available. The information is out there. It's just not widely distributed. It's not taught in schools. There's no interest for the industry for people like that. We know about this because it basically makes them useless and redundant. And so we can do most of these things without the financial industry. And so, that knowledge transformed my life and allowed me to really quickly sort of become independent from my own income. And today I don't need an income. I don't need a paid job to live. I just live off of the returns of investment that I have, which I'm thinking we're going to talk more about in this live. Yeah.
Yeah,
so that's a short story.
We'll jump
couple of other things. Yeah. So a couple of other things. I'm married and have a baby, and that's my life at the moment. It's like I'm spending all my time with my kid and my wife, and that's sort of a blessing. Like, really happy to be where I am, and I'm really lucky to have found out about this information when I did. And so I'm kind of in a mission to help other people realize that they can do this too.
Yeah, we'll jump in a little bit and tell more maybe of my story a little bit to let those who are listening to us understand how stock investing actually changed your life and how it can actually contribute to your wealth. I'm sorry for the noise on the background, so I will try to put the microphone closer to me. So the reason why I started investing, and some of you probably heard that story already, is that I worked in Google several years ago. So when I started working for Google, they gave me several shares. Please, by the way, let me know if you can listen, if you can hear me well, or the noise is like really unbearable.
It's good from my side.
It's good. Okay. So I got some shares from Google when I started working for them. and the value was around 4,500 euro. That was, I believe, 2011 when I started working for them. And then 4 years later, I left Google, and the shares left together with me. And then I moved to Belgium, and I started to look at the property market, and I saw like how cheap it is compared to Ireland, because in Ireland it was like, yeah, close to impossible to buy property, even if you had a good salary, like it was in Google. Um, but as you know, in Belgium, you need to pay quite high tax in the very beginning. So it's like 10 to 12%. And I was like, oh, wow, like where I had some savings, but not enough. And I was like, okay, where do I take this money? And then I remembered that I have Google shares, which I didn't even check, for all these years. So I had a look, and 5 years later, I had 22,000 euro. So versus 4,500 euro. And this is the reason why for for the 3 years after I sold those shares and I bought an apartment in Antwerp, I was searching for the ways to invest. And it was not easy. I couldn't find the right platform. I didn't completely know what stocks and shares to invest into. And that's why I was searching for people like Sebastian I would be able to learn from, to become a good investor and, to generate my wealth while I'm sleeping, because that's basically what happens. And we are not going to talk today about this daily trading. I think it's called like forex, right? When you are constantly looking um, at how the market is performing and then reacting on it. No, that's not what we want to do. We want to invest and we want to hold, and this is what Sebastian is going to tell us about, how to not getting stressed, about what kind of stocks to invest into, when to buy them, when to sell them. We actually don't really care about that. So Sebastian is going to tell about it, and I'm going to zip my mouth, like give a microphone to a woman. She will never shut up. So Sebastian, the floor is yours.
But I think you should keep speaking, because I mean, this experience you've had, and your knowledge of investing is something people need to know about. So, but joking aside, yes, look, your experience with Google is obviously, it can be a light bulb moment, right? And you've been lucky that you got those, because it basically led to realize how powerful that can be. But not everybody has that chance, and also could have gone completely wrong, right? Because it was a single stock, and companies go up and companies go down in terms of value. If you had some airline industry company stocks, and then you realize now that everything is crashed, it could be like, the stock market is not for me, right? The problem with that is, yes, it can be super powerful, and it can multiply your wealth super fast. It can also drop very low. But I mean, these are dangers that we know of in the stock market, right? But the approach that I like to talk about is an approach that basically mitigates all of these issues, and as you said, is a long-term approach, buy and hold, where we don't worry about short-term swings and when to buy, when to sell, try to make a profit, cut losses, and all this. There's no such thing. And as you said, it's not day trading, so we're not trying to make a quick buck. We are here to invest for the long term, like for your pension, basically, right? Or for retirement, if it's earlier than the usual retirement, like mine in a way. But so yeah, investing. There's several ways of referring to this approach of investing. You could look up index investing on Google or any other search engine, and you'll find a lot of information on this simple approach, right? So the idea is that we want to invest for the long term, and we want to benefit from the growth in value of the global stock market. So we want to diversify. So we were talking about investing in a single stock and how that could be very profitable, but also very dangerous. And basically, one way of mitigating that issue is diversifying. And so diversification is something that a lot of people talk about, right? You always say, don't put all your eggs in one basket, because if that basket breaks, all the eggs are broken too. So in investing, that's what we do. We diversify. And basically, the approach I like to take is diversification to the maximum. And that is invest in everything. in everything that is tradable on the stock exchange, we buy all of it. And it's not complicated. And actually, we're very lucky that there's an instrument that does that for us. It's called an index fund. And more specifically for non-American investors, it would be an index ETF fund in most cases, an index ETF, which is something that we can buy on a stock exchange. And we do one transaction. And with this one transaction, we have invested in the vast majority of companies that are tradable on stock exchange around the world, including the US, Europe, Asia, everything. And so that is the power of diversification, in the sense that it's become so easy for investors today to, in one go, get like an amazingly diversified portfolio that benefits from the growth of the entire planet. So basically, we're betting on the capacity of humanity to be prosperous and to create value over time, which it has been doing in the past 200 years. The stock market's been going up relentlessly, despite all the crashes, despite all the fears, despite all the doomsday scenarios. It keeps going, right? So yes, it crashes, it comes back, and then it grows further. And that's what it keeps happening. There are cycles, which we can or cannot predict. From my perspective, we cannot, but that's the idea, right? So diversification, long-term investing, these are sort of the core components of this investment approach.
Can I jump in quickly for clarification? Ladies who is listening to us, please let us know if any terms are not clear for you. So yeah, we would be able to clarify it. It's important that you understand what we're talking about, like particularly about ETFs.
So maybe I try to turn on my phone and see if this thing works, like what we just talked about before. If I can join the live with my phone, I can then draw and make things much clearer, because it's going to be on paper.
Let's try it. So while you're trying it, I will try to clarify a little bit more what ETF actually is. I can.
Yeah,
so ETFs, you probably have heard about such things as Dow Jones or S&P 500. Yeah, I can see the comment now. Everything is okay for now. Yeah, just in case if someone is listening and didn't understand, and Sébastien is setting up his phone.
Yeah.
So one of the most famous ETFs out there is S&P 500. So this is, well, let's take the American one, S&P 500. It's usually Vanguard or iShares, because there can be different managing, I don't know if to call them agencies, that manage those funds. And those funds includes an kind of an aggregate of 500 top best performing companies in the United States. And yeah, the reason why it is the risk is much lower investing into those kind of stocks, ETFs, is because they are self-renewable, self-cleaning, let's say. They're self-cleaning. So whenever there is a company which is not performing well, or it went bankrupt for some reason, it actually leaves that list. And the new company, a better company, is joining, keeping the performance of the stock on the high level. And that's why they're usually always growing. So of course there are some dips, especially during the periods, for example, like COVID. There was one, but they do grow on average. I don't know, Sebastian, if I will tell the wrong number or not, but I think on average ETFs grow from 8 to 11% per year.
So that will depend. Just before I answer, can you hear the echo?
I can hear echo. Maybe I can remove sound from one of your devices. Okay, I removed one, so I will show it in stream. Ladies, please let us know if you can hear what Sebastian is telling. I will remove myself from the screen, so you will have more space for explanation.
Yeah,
but do let us know.
But look, I think on the screen people can see me twice, but not the piece of paper.
No, they can. I think you can see the piece of paper now.
All right, because I see myself twice. Right, I see myself twice, so I'm not really sure. I guess I could just continue, right? But Um, and maybe there's still echo. Like,
Okay, don't worry. I will check. I will check now the Facebook if they see it correctly, and you can go on meanwhile. Yeah, I can see in the comments. I can see paper. So
yeah, okay. All right, then look, there's an echo. It's because my phone, I cannot turn off the volume. Oh, wait. Yes, I have a way of handling this. All right, let me go. I think
great.
I think we'll fix it like this. There shouldn't be an echo anymore. Right.
Yes.
So, all right, let's do this. So the very basics of investing, and just building on what Anna was saying now. Um, yes, so the typical way people see investing is that they see there's a company that looks fancy, right? It's called Tesla or it's called something else, right? And there's maybe another one that they find fancy as well. And so they say, I'm going to buy a share. And a share is basically a portion of ownership in that company, right? And so you can buy that through the stock exchange, right? You can buy the share through a stock exchange. And as an investor, you just go there, you have a brokerage account, and you put money in there, and then you can get the shares, right? So that little share will move into your account, right? And so that's the traditional way of investing. And people will say, well, I'm going to buy a share of Tesla, I'm going to buy shares of this, of that, of this, and that. Now, that is fine. The problem with that is transaction costs can add up quite fast. If you want a diversified portfolio, you'll have to buy, at least 20 different companies, but ideally you want more of that because you want to maximize diversification. And basically what an index, what a fund is essentially a collection of shares from a bunch of companies that come together, right? So we have, say, in this one, we show 3, but let's say there's many more companies, right? And so we have basically a pot of shares that is being bought by the money of several investors. So that is what a normal fund is. And what to invest in those things, you need to buy. You basically go to the fund management company, and you say, hey, I have 10,000 or 100,000 euros and I want to invest in your fund, in this specific fund. And I say, okay, just wire the money to this account and we'll do the purchase for you, right? So that's now how it worked for a long time. That's how people would have diversification. And this was a smart way of doing it because then you combine your forces and you can be a bigger player on the market. You can actually get better rates, better fees. And overall, there were economies of scales doing that. Now, that still requires large amounts of money because to be able to get in, you need a large sum. And then there's a number of fees there that's still quite high. What has been developed in the past 20 years is something that's called exchange traded fund. An exchange traded fund is essentially the same thing. It's a fund like that. But instead of having to pour money in directly without going through the stock exchange, this exchange traded fund issues something that's called ETF shares. So simple small units of the big basket, right? And those small units are then sent to the stock exchange and can be traded just like stocks. So an exchange traded fund is basically something that is between a stock and an investment fund or a mutual fund, and it has the benefits of both. So it has the benefits of an investment fund that it brings a wide diversification, right? So by doing a small purchase, you get access to a lot of different stocks, and so let's say you go to all American stocks, right? Or whatever, you go for the S&P 500, which is the top 500 companies in terms of size in the US, right? So that would be one way of doing that. You could buy an ETF that follows S&P 500, and basically by buying one share, you would put money in 500 different companies. Or you could go global, right? Some ETFs would just buy a shares in companies all around the world, everything that's available to them, or to a certain extent, right? There's different ETFs doing different things, but that's what I like to talk about. And so that's the diversification. And then instead of having to send, I don't know, 10,000 euros to a fund whenever you have 10,000 euros, you can actually buy an ETF share on the stock exchange for as little as 25 euros, because those shares are traded at, they're some of these shares are around 5 euros, some are maybe typically they're under 100 euro per unit. And so you can access this fund with much smaller amounts and at a much lower cost, because trading on a stock exchange is not very expensive. There are discount brokers. And so that would be this piece here that allow you to do this at a very cheap price, and even in some cases for free for specific products. And so this is a very powerful way for anyone in the world, literally, to access the very best companies and invest in them at a very low rate with very little capital. So you don't need to be rich to start investing. That is just a lie. You can start with as little as 50 or 100 euros a month, no problem. Even you don't even have to go per month. With 100 euro, you can buy a share, and that thing can grow over time, right? But ideally, this is a technique where what you want to do is be able to save on a regular basis and invest gradually and grow your portfolio. We'll go into that a little later. But basically, this is how investing in exchange-traded funds works. And what we like to do is not buy just a few companies, but buy everything. So we would buy an ETF that follows an index that basically tracks the entire world. And there's a couple of indices there, but there's a few options there which we can talk about in more details if you want. But that is sort of how the whole thing works. Now, what Anna was saying is expected returns, right? So over the long term, people like to look at the S&P 500 as a very as a benchmark for the market. It's like it's the very first index that was created, so people use it a lot. And the S&P 500 has an average return of 9.6% ever since it was created annually, right? Of that, there's a portion. Is it 9.6? Yeah, it's between 9 and 11. I'm not actually completely sure. Between 9 and 11. But this is average annual compounded return, which means that it can do far better, it can do far worse. So some years the S&P 500 did minus 50%, right? So in a given year, you could lose half of everything you have if you sell at the bottom, right? If you sell at the end of the year. And then some years it does plus 50%. That's sort of the range of returns you can expect, but that varies a lot. So say it could be that one year it does 20, the next year it does minus 15, then it does just 5%, then it does minus 30, and then it does 45, and then it's 30, and then like the returns can change a lot over time. So this is just return on investment. But if you look at what it would look like for, say, 10,000 euros, then you'd have 10,000 euros here, and it grows, it goes down, 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 up. So it's a wild ride, right? It can be a wild ride. And this is for something like the S&P 500. It would be even worse if it was a single company, because what you would get is a lot more variation, a lot more volatility. But by diversifying, what we do is we buy basically one company that does this, but another one that does this, right? And on average, you will have something that's smoother. So you'll have a portfolio that does this, right? Something like that. And over the long term, on average, that could be 9 to 11% if you go 100% stocks. So that's sort of the idea. We don't want to be investing for the short term, because we could be basically saying, well, I need to invest for 3 years, and it just happened that 3 years you're here, right? You're at the bottom of the thing and you've lost a large part of your investment. So we're not investing for the short term. We're only investing for the very long term. Because of the long term, we know we're going to get very good returns of this kind. Now, another way of diversifying is to not only invest in stocks, but also look for other asset classes. And as investors in index funds, we like to go for bond index ETFs. So bonds is not a share in a company. It's basically a loan that we make to whoever is borrowing money from us. And in return, they pay interest, right? And you can basically lend money to the government, to some companies, etc. We like to go for the safest bonds possible. So we would lend money to the largest and safest governments, because these ones are guaranteed to pay back and they've never defaulted. And so we like to lend money, or basically buy bonds from countries such as the US, or some of the big economies in the US, in Europe, Japan, UK, etc. And so that would be for the stable part of our portfolio. So say this is how a stock index would go, right? A bond would do like this. right? So it's a lot more boring. It doesn't go up and down, but basically what it does, it stabilizes your portfolio. So when you look at the money altogether, it doesn't go up and down like that. It will just go like this, right? And you have basically much more constant growth. And yes, you give up a bit on the returns, but you are managing your emotions, you're managing your portfolio, you're minimizing the losses, and you're banking on long-term um, on the long-term returns with a balanced portfolio. So that's the idea.
Can I jump in here because we we have a question which was asked
Yeah.
earlier in the group from Alessia Bekerova. I'm interested in high yield savings accounts, government bonds, and treasury
Mhm.
securities that are in practice in Eurozone. What is the best place to invest in them, and what is the percentage and what percentage of the fee you have to pay? So it basically comes to the platform, I think, here.
All right. So my understanding of the question is how to get into high yield savings account or bonds. So these are what we were talking about here, which is the other asset class, right? Which is safer and returns less over time, but it's here, right? So that is bond. Now there's a wide variety of bonds. Yeah, we're coming back to the stream. So this is what my understanding of the question is, that how do we get this part here? So in this portfolio, what she's referring to here with the question is, how do we get money into high yield savings account or bonds? And so these are something that we called fixed income assets, right? Because there's, once you have your money in there, you get a fixed interest rate that's paid to you, right? And on a regular basis, or whatever it is, the system it is. But basically, it's almost guaranteed income. It's typically lower than whatever you would get in a stock, because you don't take the risk, right? It's like very low risk and hence very low reward. Now, when we talk about high yield bonds, there's a lot of different bonds. So you can lend money. We talked about money being lent to, right? So if you put your money in a savings account, what you're doing is you're lending money to the bank, right? And it's readily available. It's get flexibility, and so you can take the money out when you want. And the bank is fairly safe. You don't take very many risks, but that means you're not going to get very many returns either. So in Belgium, I'm taking the Belgian example. The average savings account in Belgium returns gives 0.11% on an annual basis, right? And so that's data for the past 2-3 years, and it will change in the future. But this is where we are today. It's very, very low. It's so low that it's lower than inflation, right? Which means if you put money in the bank account, you are losing money, right? Inflation is around 2.5% at the moment, which means when you leave money in the savings account, you're losing money. It's not going to be able to buy you the same thing in 10 years. You will be able to buy far less with the money, despite having received 0.11%. So this is why it's so important to invest, right? If you have a large sum of cash sitting in a savings account, it's losing value. Now, yes, we're talking about high yield savings account or high yield bonds, which could be essentially alternative to this, right? So instead of saying, well, I'm just going to go with a whatever regular savings account in Belgium, I want to make sure that this is optimized to the highest level. Now, what happens when you do that is that you're willingly taking more risk, right? So there are various ways of achieving higher rates of return through savings account or bonds or loans or lending. But the more return you get, the more risks you get. So you could go to an online bank, right, which might not have the same security level and maybe promises 1%. I think there's a couple places where you can find that. Now, you've increased your risk a little bit. Why? Because the bank is not as solid. It's probably a smaller one. It doesn't have the same backup from the government. There's a bunch of things that maybe there. They have lower costs, obviously, because they don't have any offices. So there's a bunch of things like this, maybe not as convenient. So that's what happens. Now, it's still not as high as inflation. So you could do that, take a bit more risk, but you still don't beat inflation. You could go to bonds, which the person asking the question was mentioning. And with bonds, it would be something similar. If you go to the safest bonds possible, you'll get a very low return, right? I mean, in Switzerland, it's even negative return. People are willing to pay the government to keep their money because of the current interest rates are extremely low globally. So that's kind of the extreme. Anyway, if you want safety, then you won't get many return. But if you're willing to take more risk, then you can. get more returns. Now, with bonds are typically rated based on their quality, and there's a couple of 2 or 3 rating agencies, but basically you see often AAA, which would be like the highest quality of bonds, and then at the bottom it would be called C or D or whatever. But basically these are high, like super high quality bonds, right? And then here would be things that we call junk bonds. And basically junk bonds are issued by the companies who are willing to give a lot of returns, but because no one else is willing to lend them money. So if you want higher returns, what you're doing is basically you're going to the companies where the bank themselves say that's too risky for me, I'm not giving my money to these guys, which means that these companies have to borrow from someone else, and they will try to borrow from individuals who are looking for high returns. But those companies have been assessed as not safe, right? There's a higher chance that they will just not pay back your capital at the end of the lending period. Now, most of them do, but say there's a 5% chance you don't get your money back, then maybe a 5% return on investment isn't worth it, right? And this is what's happened with lending in like at the beginning of the year. Peer-to-peer lending is something that has been taking off a lot in Europe because it's an alternative way of financing certain projects which are deemed too risky for normal banks, also small projects, etc. But there's also been a bit of an abuse there, where companies that are basically not safe have been promising high returns, and there's been a lot of enthusiasm among investors because for what it worked, and it works when the economy does well, peer-to-peer lending will do well. But the moment something goes wrong, peer-to-peer lending is the first that's gonna because it's gonna suffer from it. Why? Because those companies are not that safe, and basically they have in their terms and conditions when you lend to them, when you basically buy a bond from them, you're the first one to go in case something goes wrong. The institutional investors and the institutional lenders will get priority to be paid back. So higher returns on bonds means more risk. Now, the issue with that, I mean, if you're willing to take the risk, it's a fine thing to do, right? But say you get close to 0% up here, and here you could go all the way to 12%. Sometimes we see promises of 20%. I would never, ever put my money in there. Why? Because I'm taking so much more risk than if I was investing in the stock market, right? So the stock market, you basically are owner. You become part of the shareholders of the company, right? Whereas if you're lending money, you still don't get all the gains. You get, basically they'll say, well, we'll give you 12% gain. That's great. But they're hoping to make 100 or 200% gain, and they'll give you only a small part of it, right? The reason why these companies are willing to do this is because it's high risk, high reward, but they limit how much you will get. Whereas if you buy stocks in the company, then what you're doing is you're becoming a part of the company, you're becoming an owner of the company, which means when the company makes a lot of money, which it's trying to do, then you get the benefits as well. You're not limited upward. Here, you have a limit. There's a cap, there's a ceiling as to how much you can make, right? With a company, if that company makes 40% that year, you make 40% that year. If the company goes bankrupt, you go bankrupt. But that would happen here too. If the companies go bankrupt, there's a good chance that you will not get paid back. So instead of looking for high yields, my general advice is, it's not just my advice, is in the world of index investing, and something that if you're interested in this, like Google Boggleheads. Like Boggleheads is the keyword. This is where most of this started. It's a community of investors, which I'm part of, where people basically talk about this and work on these principles and apply them and help each other, right? So I'm part of that community. You should join. It's investors for investors. No one's making money out of this. So it's extremely powerful. And so what we say is, if you want high returns, don't go for junk bonds. Simply have more stocks in your portfolio, because you get all the benefits as much as the risks, right? Whereas here you take all the risks and you just don't get all the benefits. So that is the limit. Now there might be bank accounts where you get 1.5-2%, and it's still fine, right? But will never be as good as a stock investment, and you have increased your risk a little bit.
Yeah, I will jump in here because we're talking a lot about bonds, and I was thinking that maybe we should talk a little bit more about ETFs and also answer the questions that we have got.
Yeah.
But one thing about bonds, I think that it's important to know is taxation. And I know one of the questions was actually about taxation from Maria. Any taxation matters to keep in mind when buying stocks and bonds? And I know Maria lives in the Netherlands, so I don't know how the taxation in the Netherlands,
Yeah,
but
it's
in
quite different.
Belgium, bonds are taxed at 30%, from what I remember.
On capital gains, yes.
On capital gains, yes. But the good news, good news, when
Some
you
bonds, yeah. So not all of them, but yes, there's a bunch of things. Sorry, go ahead.
Yeah, the good news, and I've actually learned that from Sebastian, and I'm extremely grateful for that, is that there is no capital gain tax on buying stocks in Belgium, which is absolutely amazing because I lived in Ireland and the taxation was like 50%. In Belgium, you only pay tax when you buy and when you sell. Is that right?
For accumulating stock ETFs, yes. So there's a bunch of different categories in terms of
And
ETFs.
it's
But
very, very low.
yeah, and there's one like obviously we want to optimize for taxes. And so going for accumulating ETFs, so these are ETFs that are reinvesting the dividend directly without distributing. The dividends don't come to your account. They stay in there. And in those ETFs, if they're not registered in Belgium, so that's another very important aspect, registration, the country of registration. So if they're not registered in Belgium, then those ETFs are both the lowest in terms of tax in transaction, right, which you mentioned earlier, which is can be very low as 0.12%, which is specifically those ones for accumulating ETFs that are not registered in Belgium and registered in the European Economic Area. Anyway, and then on accumulating ETFs in general, there's no capital gain tax, which means yes, Belgium is one of the very few countries in the world where we can grow wealth almost tax free from the capital gain perspective, and it's insane. It's like it's I mean yeah I understand why there are rich people coming from France into Belgium and basically moving their portfolio here. They don't want to be paying the 30-40% 30-40% tax that they would be paying in France. It makes complete sense. And so we are very lucky as Belgian residents for that. And yeah, but you need to pick the right ones, because if you get a distributing ETF, then you start paying tax on dividends. And then if you get the wrong ETF, maybe you get also some higher tax on the transactions. So there's a bunch of things. Also, the domiciliation of the ETF is important. So you want an Irish domicile ETF so that you minimize the estate tax in the US, and you minimize the withholding taxes as well. So these are some considerations. So the technical aspects of investing is basically looking at all of this stuff, like the taxes and how to optimize for them.
Yeah, so I will. If you have any questions, by the way, I can see, ladies, there are 10 of you watching to us, which is great, which is amazing. I want all of you to invest. Do ask the questions. If there is anything you want Sebastian to clarify, please do it now. And I will, meanwhile, go through the questions we have got in the group. So there is a question from Prima. What is the minimum amount to invest? A comparison of the different platforms and any relevant strategies.
Yes. All right. The very first one is easy. What's the minimum? There's no minimum. There are some specific brokers that offer you transactions for free. And so if you invest €5, I think it's doable, because there are some ETFs that are lower, like that, cheaper than €5. But I would say, if you have 50 or €100, that's good, because that's it. You can start. It will cost you almost nothing, and you can benefit from the markets over the long term. Yes. So I would say from 50 or 100, go ahead. Like,
Can I jump in here? Because I was attending one of your sessions with one of your guests, and there was a very good example that he brought about compounding effect of what you invest. And there was an example of investing $150 per month during the period of 40 years, with the growth of portfolio about 9%, I believe. So if you invest 150 dollar, well, in our case it's euro, every month for 40 years, not withdrawing those money, not touching them, allowing them to grow, because you will also be getting dividends, and your amount of money will be growing, and there will be the compounding effect on it. You will get in 40 years I don't remember the number now.
Yeah, but it's,
It
I
was
mean,
close to million. It was 600,000, something like that.
yeah,
Well,
look, I've got this on some slides, and we could, I mean, if this is of interest, I'm happy to come back and talk about more of those details, and show how that works. But yeah, basically, like simple rule of thumb. 9% is quite high. If you include inflation, then you look at 7%, for example. Over 10 years, at 7%, your money doubles. That's an average, right? So if you have 10,000 euros today, in 10 years, it'll be worth 20. And in 20 years, it'll be worth 40 because you double and double again. And in 30 years, it'll be worth 80,000. And in 40 years, it will be worth 160,000. So over 40 years, it's times 16. And most of you have that time horizon. Even if you're already in your 40s or 50s, you're likely hoping to live at least another 40 years, and that money will be growing for you during your entire life, even in retirement. So if you retire at 65, it doesn't mean you take all your money then. No, you want that money to keep going, right? You just take a little bit that you need, the rest stays there, and for the next 20 years it keeps going. So yes, we have a long time horizon, and the power investing is in the time. So the earlier you start and the longer you stay in, that is how you get the best results. That is the most important aspect of all this, is how much you put in and how long you stay in. These are the two main variables. So saving more and starting earlier or staying in longer, buy and hold, stay the course. These are the key. Like, this is the most important. Everything else is technical details, is small things. It's going to change your returns by 5-10% max. But these two things will make you either broke or wealthy. Like, that's it.
yeah. And I found the numbers, by the way. Yeah.
Yeah.
So $150 a month is $5 a day. So instead of maybe, paying your coffee, five in Starbucks every day, if you put that money into stock investing, that means that you will save 73,000 dollars over 40 years. So with a compound effect and with 9% annual return, that's gonna make you 657,000 in total. And this is absolutely amazing. And yeah, I'll tell you that I started investing again, after I sold Google shares and bought an apartment. So I started investing about a year ago. Lying here, about 7 months ago. uh, and when COVID started as well, like, I bought a little bit more because it was a big dip. And my portfolio is, of course, it's fluctuating, but it's already 20 to 30% more. So this is what I've gained, let's say, in 2020. And I know a lot of women have, not only women, I mean, a lot of people have this fear of investing because they think they need to invest a lot or they need to be rich to invest. But honestly, as I gave you an example, you can invest 50, 100, 150 euro a month and grow your portfolio in that way together with the compound effect. And there are platforms nowadays that allow to buy fractional shares as well. So let's say you want to buy a share of Google or Amazon or some expensive ETF, let's say, but you don't have 1,000 euro that it costs. So you can buy just, a fraction of the share at 50 euro. And this is actually what I do. And you can grow portfolio that way. Voila. So these are 5 cents from me.
Yeah, no, that's really cool. I think there was a question about the platforms, no? So, I mean, in terms of platforms, there's I would say there's two main ways to do this well in Belgium. There's no, we don't need my piece of paper. You can either do it all on your own, DIY, which is what I do and what I teach and what I'm encouraging people to do, and where that's basically my whole game is around that. And that is you open a brokerage account. So that's like a bank account, just that it's a bank account that gives you access to stock exchanges. And there you are basically master of everything. You put the money you want, and then you go buy the products you want. The brokerage account is basically access to the supermarket. And then you pick the supermarket, which is the different stock exchanges. And then in the supermarket, you pick the product you want to buy and you invest. And that's just what it is. And the whole game is pick the right ETF in the right supermarket, buy and hold. That's it. It's super simple. And that's the DIY approach, super powerful. And then the other approach is to say, I don't want to handle all of this stuff, and I'd rather someone else do that for me. If that's the case, then you will have to pay a fee. Now, here, the work that needs to be done isn't very big. There's not so much. So it makes no sense to pay a high fee for this. And there are companies that now are automating most of this work so that they can basically let you invest for a low fee. And these are the ones that make sense to go with. They've been referred to for a long time as robo-advisors because it was so automated. But they're introducing human elements into this, and they don't call themselves robo-advisors. And these are good platforms too. There's a couple in Belgium. I think there's Birdie, EasyVest. There's one that's being developed specifically for women, Star Tailors. They're not live yet. There's Curvo. So there's a bunch of players in the field. And they're all looking to make investing easier for everyone at a low cost. Now, I don't feel like paying this extra fee, but for a lot of people who don't want to do the learning and handle all of this on their own, their services are amazing.
There was a question as well. I will also add a little bit on this part as well. But first, I will add more to this question. There's someone asking, how do you actually choose the right platform, and how do you kind of check the security of the platform? Because there was a very unpleasant case. Someone from Fearless Female Founders has shared with me that she invested something like 7,000 euro in a platform that ceased to exist. So she lost all the money, unfortunately. So you should be very cautious about that. And maybe Sebastian can give some advice on how to avoid these kind of situations.
Yeah, so I remember that example, and these are platforms that promise a lot of return and that don't really explain how that is done, right? And so it's almost too good to be true. And typically, you get convinced by someone who has an interest in getting you into the platform. If there's a platform that comes and really insists that you jump in because it's so good, there's something fishy about that. Typically, those platforms will not do that, and people will not be making money by getting you into those platforms. So I would say the first sign is the very best thing that's out there for you is something you need to go and get for yourself. If someone else is trying to sell it to you, it means that person is making money out of it. And how do they make money? That is out of your money, right? So if there's an advisor that says, hey, you should buy this, and here are all the reasons, and they say, by the way, I'll give you advice for free, that's not true. They're getting paid by whatever the system is behind. And the way they get paid is that money is taken from your thing, from your investment, and is used within the system, right? So avoid going for something that people are pushing to you. Go for things that you go and look for yourself. That's for me, that's like a basic principle. Now, there are very solid brokers. So what you need is an online broker, or a robo-advisor, but that is completely transparent and regulated by the government, right? So those who have the right licenses, that are based in Belgium, they declare taxes. The management team is available. They declare the taxes. It's all there. It's clean. Like, that is super important. If anything is hidden, then they're hiding something. Like, if you don't know who's the manager, who's the boss, and who owns the company, then they're trying to. They want to make sure they can disappear at a moment's notice, and that's not a good sign. So I would say these are the biggest ways of realizing that. If they promise you, if there is like a program where they say, look, if you get in, then you get into the same program, and if you get more investors, you're gonna get so much more money. That's a pyramid scheme. And that is the worst that can happen. Yes, you can make a quick buck, but most people will lose because only the guy at the very top will make money and disappear. So like, that's for sure something to avoid. But investing is simple, and it's like, you cannot expect 20% return. Like, Anna's saying 9%. I think that's the highest on average you can get, and you shouldn't never be tempted by getting anything that's higher than that, because it makes no sense. And these are fishy things or highly risky products or schemes, and they're best to be avoided. Like if it's too good to be true, then it is too good to be true and should avoid it. Like building wealth has to be done the right way, and that is by creating value. And creating value, the very best way for that at the moment is private companies that you can access through the stock exchange, and you can become an owner of as a shareholder. And that is how you grow your wealth, by simply saying, hey, Jeff Bezos and Mark Zuckerberg and all these guys, you guys take a bit of my money and make it grow, right? I'm counting on you. I know you're the smartest. You've already proven that you could do it. And then you say, hey, all the small entrepreneurs who are just being listed on the stock exchange, you guys have been doing great so far, and you're still kind of underdog. Here's a bit of money. I'm betting on everyone who's entrepreneurial and who's been already successful in growing companies. And you say, on average, all of these people will bring the value of my own money up with them, right? And that's what you want.
I will add a little bit on that. So what you also need to check when you choose a platform, you go not only on their page, but also on reviews, and you check, as Sebastian said, where they are registered. So they need to be legally registered. They need to have proper licenses, and usually it should be shown on their website directly. And another important thing is they should have insurance, and that information should be also clearly displayed on their website. Who is the insurer, and what is the amount they are insured for, and how much you are going to you will get back in case something will go wrong, something that will go nuts. There is one thing I would like to share with you. Let me see if I can share the screen. It's different platforms. Sebastian, I will remove you for a sec.
No problem.
Okay. I hope you're able to see the screen now. So this is the link I can share with you later, and it lists different kind of brokerage accounts, and it also gives all the information about them. What kind of fees do they charge? What kind of options do you have? Do they have? So it's really handy. Another thing I wanted to tell you is also something I have learned in Sebastian's community is that people diversify not only their portfolio, but they also diversify their brokerage accounts. Meaning that if something goes wrong with one of accounts, then they can still have their money on another brokerage account. And I have seen a couple of questions more, which we are going to answer. But I would like to quickly show you the bonus you will be able to get after this interview. I will post it either today or tomorrow. So this is a free guide which decodes 10 myths that block you from investing in stocks. And we covered some of the myths today, but there are more of them. And what you can also do, some of you have already taken this course of mine, but some haven't yet. And this is the course where I share my own experience with the platform that I use. And I basically show step by step how to buy your first stock. And the reason why I have decided to create this course is because this was my biggest struggle. So I understood theoretically how it works, but I couldn't choose the right platform. I didn't know how to do the first purchase. This was the most difficult part for me. And that's why I decided to share this information with you. And it includes several bonuses. And one of them is very popular among women. I know that because I've got several questions about that, is make a difference with socially responsible investments. There is e-guide on how to invest and like Warren Buffett, 24 best books on stock investing, wealth generating affirmations. So you have the whole bundle, and the value of it is €894. But I give it to you for only €28. And basically, after this course, which is short and clear, you will be able to invest already next week. So I will bring back now Sebastian. Let me hide the screen. Yeah, someone is saying it's not visible. It's very blurry. Sorry for that. I don't know what happened. Probably the internet is not the best, but I will post the link so you will be able to access it. And now let's come back to questions. So Imoki is asking, given that COVID-19 might stay with us for years, how do you see the future of investment in the next 2-3 years?
Yeah, so that's a very common question in the investing world. The truth is nobody can predict the future, right? That is the very basic truth. The way the stock market behaves always surprises more than half the people, which means it always surprises people and almost everyone. And there's very few people who have been successful in predicting the stock market directions successfully. Very, very few. And actually, if you had to pick someone, there's a good chance that the next time they predicted it's wrong. When one of the top investment managers, I think, is the owner of Fidelity in the US, when he was asked, "What do you think the market's gonna going forward? He said very thoughtfully, "It's going to fluctuate." So that's the answer for everything. Now, look, in March the market crumbled for a little bit, right? It went down 30%. And people were expecting that to keep going down. I mean, the economy everywhere is suffering, yet the stock market recovered, right? 2 months after that, we were back at the same level. Completely unexpected. No one could have predicted that. It goes against everything people know of how the economy works and how the stock market and financial markets are related to the economy. It just doesn't work. So we don't know, to be honest. And I have several friends who have tried to be smart about all this, and they burned themselves. And that's just the comment. Like, everyone goes through that phase at some point, trying to be smarter, and gets burned. What I want to say is, yes, it's kind of gloomy in terms of outlook, because the market could be doing this for now, but people are still expecting it to crash, right? Again, maybe we're not. We don't know. But even if it does, it's actually good for you. Maybe not for me, because I depend on my investments. But for the vast majority of people who are investing and who have not retired or do not depend on their stock investment portfolio already, lower markets is better because you can buy more shares at a lower price, right? So we were talking about Google earlier. If Anna had bought more shares in 2016, when it had already quadrupled in value, she would have had to pay 4 times more for the same share, right? But if it had gone down, she could have maybe, say, if it had gone down to 2,000 per share, whatever, I don't know what it is. If it was half, then she would have had double the amount of shares for the same amount of money. So you, as an investor, you should be rooting for the stock market to go down. You want the stock market to go down. Like Anna was saying this year it's gone up 20%. And that's what we hear a lot. And from a short-term perspective, it's like, oh, that's amazing, you made 20%. It means like next year maybe 20% again and then again and again. But what you want is not 20% every year. What you want is zero for as long as you're investing, and then all the returns at the end. Actually, you want the market to go down. You want, if it could go down 20%, 50%, even 70% in the next year, that would be better for the vast majority of you. Unless you have $1 million portfolio already up there and you don't want to lose all of that. But if that's the case, then you need a very balanced portfolio, conservative, which is what I have, because you're more worried about losing a large chunk than making a large chunk. So I would say I wouldn't worry about it, both because if it goes down, it's actually good for you, and secondly, because you can't predict the market, and the very best time to invest is today, and buy and hold long term is the solution. There's no need to worry about where it's going to go. Like, the whole index investing strategy is about saying there are things that I can control, and then there's things that I cannot control. What I cannot control, I'm going to try to mitigate, and I have a strategy that works in any scenario. This is what index investing is. It doesn't matter what the market does, you'll be fine. Why? Because you buy and hold. You buy regularly, you optimize and control what you can, which is cost, taxes, diversification, your asset allocation, right? And your own behavior. That's what you can control. And you optimize those things. And then what you cannot control is stock market, then you mitigate. You have diversification. You buy bonds in your portfolio. You buy regularly, which gives you dollar cost averaging or euro cost averaging. So that's how you handle this sort of ups and downs and actually benefit from it. You want this market to crash, which is weird. But index investing is very counterintuitive. You want things to go wrong because that's good for you. It's weird.
Yeah, that's very good that you mention it, because honestly, I was waiting for that crush, and a lot of people were talking about it, because a lot of specialists say that market crashes happen every 8 to 12 years. So something was expected, but of course, no one expected that it would be COVID. But for me, it was like, yay! I shouldn't I shouldn't say that, but yeah, the market crashed, and this is when I leveraged my time to buy shares because the market was low. And I know a lot of people were in panic and saying, okay, this is one of the worst crashes, and it will probably be the longest. It will change the whole economy. But the funny thing, I think this is my third crash through the history that I was born and I remember. And every time such crash happens, people go nuts and people say that's going to be the end of the world. That's going to be the end of stock market. And it always recovers like within 1 2 years. Now, I don't want to say that we will recover very soon, in 1 or 2 years. As Sebastian has told us, no one can predict what's going to happen. Maybe there will be another COVID, maybe there will be something else, maybe the meteorite will fall on the earth. I mean, who knows? What is the most important thing, as Sebastian said, yeah, you need to look at your portfolio, you need to diversify, and you need to look at the overall curve of the stocks that you're investing. So when you look at the curve of an ETF that you want to buy, you just go to Google and you put S&P like 500, for example, and you choose the whole period of that stock, and you see the dynamics of that stock. So if it is upwards going trend, then yeah, you can probably invest into it. If it is very volatile and you actually don't see the progression of the stock, that's probably not the best stock invest to. So this is my investment strategy. I can see other questions here. Is it advisable to invest in bitcoins?
My short answer is it's not advisable. So it's no. Bitcoin is a currency that is being used for speculation. It can be used as, I mean, it has value as a service and as a currency, but it's very much a bet, right? So if you want to bet money on the system and like maybe things relying on Bitcoin in the future, you can. But I wouldn't put more than 5% of everything I own. My portfolio basically would be 5% play money and 95% index investing, super safe, long-term returns, like the things that really need to work. And the rest will be play money. And maybe so you can have some money in Bitcoin if you think that it has value over the long term and that it could, be the start of a new type of economy, which, there's a good reason to think that this might happen. But I wouldn't bet any big amount of my portfolio on that. It doesn't generate value in itself. It really is changing in value due to speculation. But it doesn't generate value beyond being a currency and disrupting the economy in a way compared to, say, a company that produces equipment and provides services to help people be better, right? So there's a very different, this is different things. It's like saying, is it worth investing in Japanese yen? Maybe, right? It's a currency, right? And that's called forex. Bitcoins seem to have a slightly different place in the whole financial world because it's a cryptocurrency, but it's still a currency. So yeah, I think that I have a little bit, but I have a tiny little bit. It's like 0.1% of what I own is in there, simply because I'm thinking if it ever picks up massively, then I kind of want to be a part of that. But it's very, very, very little compared to everything else I own.
Yeah, I also don't invest in cryptocurrencies. Well, probably simply because I don't know much about them. And yeah, my feeling that they're very risky. I did buy Bitcoin a little bit, just maybe like you, a couple of years ago. I don't even know how much it is now. I never had a look into
That's
it.
okay.
But yeah, I don't risk investing into cryptocurrencies myself. So we have one last questions. Unless you still have more questions, do ping them. Yeah, there is a question from Maria. She asks, maybe some recommendations on making one's own financial plan.
Yeah. Yeah, I think that's crucial, and that should be one of the very first steps, right? So when you learn about taking control of your finances and investing, there's a few steps that I recommend people take. One is educate yourself, right? So being like watching this talk here is, a very good place to start. But read, go to the right sources, and I would say boggerheads.org is this like community website, brilliant with a lot of information. Um, we have a community in Belgium called Financial Independence Belgium, which basically focuses on that too. It's just people helping each other and learn. So education, that plus books, right? If you get the Common Sense Investing book by John Bogle, or if you buy All About Asset Allocation by Rick Ferry, I think we're gonna put things together later, no? And now I can share a bunch of links for people who want to learn. But so education is the first level. Then you build your plan, and the plan should start by saying, well, to be able to have a plan, you need to have data, and your data should come from your budget, or you're tracking your expenses. This is the important part. So you track your expenses, you understand how much you're spending, you understand how much you're saving, and you can make a forecast, right? You say, well, I'm saving 500 euros a month over 10 years. That's so much, right? And then you build an investment plan, which will be, okay, how much can I invest? What's my risk tolerance, right? How much risk can I take? Like, do I have backup plans? Do I have a long time horizon or a short time horizon? Am I stressed up about my investing, or do I want to be more or less conservative, basically? Then you decide on your brokerage account. So that would be the platform, and whether you want to do it yourself, or if you want to outsource some of this. Then you decide on your asset allocation, which depends on your risk profile. So more risky or less risky, basically, that's what you need to do. And then you buy and you hold, and that's kind of the whole plan, right? You can go more fancy and have projections for financial independence and all that stuff, which is something I'm very excited about. But that's the basics. So yeah, learning, planning, investing. That's it. 3 steps.
Yeah, and the brokerage account is actually very important. At least for me, that was kind of a tipping point in finally starting to invest, because I spent like 2 years going to different places and trying to understand what platform to use. I've been to all the banks, and it was a nightmare. Because, well, first of all, it's very complex, that the solutions that they offer. It's also expensive. They charge for transactions the fees that are like sometimes more expensive than the share itself that you are going to buy. So that's why it's very important to take time to choose your brokerage account. And again, so my bonus for this session that I have promised to you is going to be 70% off on my course, which is a little bit more than 1 hour. It has 6 modules, very easy, very comprehensible, that you can follow, and you can literally start investing already next week. And then another bonus that I'm going to give you is the ebook on 10 myths that block you from starting to invest. And then Sebastian also has his own bonus.
Yes.
Please share.
Yeah, so I'm developing a course on investing as well, but on the index investing part of it, like a little bit what I've been explaining. It's a pretty intense course. It's about 8 hours long, and there's Q&A, and it takes about a month to take and to do, and it takes people through the whole process of the learning, the planning, and the investing. So including guidance, step by step, almost holding by hands to go and do the investment, the trading, the opening of the account, all of that. So it takes about a month. The course is under development. It's been already run. It's very successful. There's about 20 people who took it, and everyone started investing. Very good. But it's not available at the moment, but I'm happy to offer a discount as well for your audience, Anna. And so that would be a 20% discount, but it will be, on the future course. The course is not there yet, but I'm happy to give a 20% discount to everyone who comes from your group. Because I think it needs to be available. The course will not be very expensive despite the size, but that will come. I don't think it will be ready before September, but I will let you know, and then you can communicate with your audience when that's the right time.
Yeah, so whenever it's available, we will just post it in the group. So you will be able to take advantage of that. And I totally recommend you to start investing as soon as possible, and also educating your family about it, your children about it. I just so regret, that I arrived at 39 years old and I just learned about it. It's like, how come I didn't know about it before? I could be like retired like Sebastian now. But I still have to work. But I do invest, and I do recommend doing it to everyone to gain your wealth, your financial independence. And I think we all deserve it, and we all deserve to do what we really love doing instead of going to the job that we hate. So that's really important. And okay, thank you. Ladies, for being with us. If you still have questions, you can ping them. I can ask Sebastian maybe to ask them a little bit later. I will not allow him into our group though, because that's the female group.
Yeah.
But I will ask him maybe to answer the question. So
I'm happy to come back and support. I mean, as I said at the beginning, I think your community needs to know about this, and I want everyone to be empowered about this, especially you ladies. So I'm happy to help wherever I can. I'm happy to come back if there's more questions, or if you want to go into more technical stuff with presentation if you want. And then my last comment was we have another community around financial independence Belgium, and people can find out on Facebook. And there's a website which I think might be helpful as well. It's called firebelgium.com. So FIRE Belgium.com. And there's also a free guide. It's called The Beginner's Guide to Index Investing. So it's about index investing, and it lists basically most of the steps that are required. It's sort of a warm up towards the course. And there's a lot of information there. There's, my talks on financial independence, my talks on investing, talks from other guests that I've had, some articles that might help people understand what I mean by financial independence and how I got to it. So these are just cool resources that are there for free for everyone to enjoy.
Yeah, and I confirm that Sebastian shares a lot of very useful information. So do follow firebelgium.com. And sending you loads of love and wealth vibes. And see you at the next session.
See you, everyone. Thanks, Anna.